On December 12, 2025, Nasdaq announced its annual reshuffle of the Nasdaq 100 index, sparking intense debate on Wall Street about potentially removing MicroStrategy, the world's largest corporate holder of Bitcoin, which could have triggered up to $1.6 billion in forced selling from passive funds if the exclusion had happened. But in a surprising turn, the company retained its spot, highlighting the growing tension between traditional finance and crypto innovators like Michael Saylor, who continued his aggressive buying spree regardless. We all know how index decisions can ripple through markets, and this one kept everyone on edge, with analysts estimating that a removal would force ETFs and mutual funds tracking the Nasdaq 100 to dump shares en masse, potentially cratering MicroStrategy's stock price by 10 to 15% in a single session based on historical precedents like when Tesla was added back in 2020, causing a 40% surge in the opposite direction. But why did Nasdaq even consider this move? And what does it reveal about the evolving landscape for Bitcoin treasuries? Let's dive deeper. Nasdaq's concerns stemmed from MicroStrategy's transformation into what some call a Bitcoin proxy, with over 95% of its enterprise value tied to its digital asset holdings, raising questions about whether it fits the index's criteria for diversified tech companies, especially as its software business, once the core, now generates only about $500 million in annual revenue compared to the billions in Bitcoin gains. As we unpack this, it's clear that Nasdaq index membership isn't just a badge of honor. It's a lifeline for liquidity and institutional capital, where inclusion means automatic inflows from the $500 billion in assets tracking the Nasdaq 100 through funds like the Invesco QQQ Trust, which alone holds over $280 billion and would have been forced to sell around $800 million in MicroStrategy shares if removal occurred, according to estimates from JP Morgan analysts on December 10, 2025. Think about past removals. When Twitter was delisted in 2022 after Elon Musk's acquisition, its stock dipped 5% intraday due to mechanical selling, and similarly, Zoom's exclusion in 2023 led to a 7% drop as passive funds rebalanced within days. For MicroStrategy, the risk was amplified because its float is heavily owned by institutions, about 60% as of November 2025 filings, with passive vehicles accounting for nearly 20% of that, meaning any index change acts like a domino effect, pressuring the price downward and creating opportunities for savvy buyers. But here's where curiosity kicks in. If Nasdaq was so concerned, why didn't they pull the trigger on December 12th? The answer lies in MicroStrategy's lobbying efforts and the broader market's acceptance of Bitcoin as an asset class, with Nasdaq itself launching Bitcoin futures in early 2025, signaling they're not fully anti-crypto but wary of overexposure in their flagship index. Shifting our focus to MicroStrategy's Bitcoin position, which is the real powerhouse here. The company held 660,624 BTC as of December 8, 2025, valued at approximately $59.55 billion at then current prices around $90,000 per coin, having acquired them at an average cost of about $45,000, resulting in unrealized gains exceeding $30 billion that have propelled its stock up 300% year-to-date. Their acquisition timeline is a masterclass in conviction, starting with the initial 21,454 BTC purchase in August 2020 for $250 million. They've ramped up aggressively, including a massive $1 billion buy in February 2021, and more recently, on December 8, 2025, announcing the addition of 10,624 BTC for $962.7 million at an average of $90,615 per token, funded through convertible notes issuance in November 2025 that raised $1.5 billion at a 0.875% coupon due in 2032. This debt structure is key. We're talking about convertible senior notes totaling over $5 billion outstanding as of Q3 2025, with maturities staggered, $650 million due in 2025 at a conversion price of $143, $800 million in 2026 at $397, and newer ones like the $1.01 billion from September 2025 convertible at $2,043 per share, allowing MicroStrategy to leverage low-interest debt to amplify Bitcoin exposure without immediate dilution. The flywheel strategy, as Saylor coined it in his October 2025 earnings call, involves using stock premiums. MicroStrategy traded at a 2.5x premium to its Bitcoin net asset value in November to issue shares or debt, buy more BTC, boost the NAV, and repeat, creating a self-reinforcing cycle that's delivered a BTC yield of 25% in 2025 alone, far outpacing traditional treasuries. Now, let's break down the 4 selling mechanics that had everyone buzzing before the Nasdaq decision. Because even though MicroStrategy stayed in, understanding this reveals the vulnerabilities in passive investing that could still play out elsewhere. Passive funds, which manage trillions globally, must mirror index compositions exactly. So when Nasdaq announces changes effective December 20th, 2025, for this reshuffle, ETFs like QQQ would have had to sell MicroStrategy holdings proportionally. Analysts at TD Cowen pegged the outflow at $1.6 billion based on MicroStrategy's 0.3% weighting in the index and the total AUM exposed. This isn't hypothetical. In 2024, when Palantir was added to the S&P 500, it saw $2 billion in inflows overnight. And conversely, exclusions like Dish Network in 2023 triggered $500 million in sales, leading to a 12% price swing. For MicroStrategy, the sell pressure would concentrate in the final trading hours before effective date, often called Index Rebalance Day, where high-frequency traders front-run the moves, amplifying volatility. JP Morgan's November 21st, 2025 note warned of up to $9 billion total passive exposure across all indices, meaning a Nasdaq boot could have cascaded into broader selling. But what if this creates a dip? Could it actually be the buying signal we've been waiting for? Absolutely, as history shows with Bitcoin itself. The 2022 FTX collapse caused a 20% drop, but institutions like BlackRock scooped up, leading to a 150% rebound by 2023. Michael Saylor's response amid this index drama has been nothing short of defiant, with the MicroStrategy executive chairman tweeting on December 9, 2025, "Bitcoin is the apex property, and we're building the future," while his company pressed ahead with that $963 million BTC purchase just days before the Nasdaq announcement, underscoring a strategy that's laser-focused on long-term accumulation over short-term Wall Street whims. Saylor, who personally holds over 17,000 BTC as disclosed in 2024 filings, has been vocal in interviews, like his appearance on CNBC on December 5, 2025, where he argued that index providers are missing the boat on digital assets as a superior store of value, citing how MicroStrategy's BTC per share has grown from 0.002 in 2020 to 0.09 in 2025, delivering shareholder returns that dwarf the Nasdaq's 15% annual average. This contrasts sharply with Wall Street's concerns about volatility. Analysts at Barclays on December 11th noted MicroStrategy's beta of 3.5 versus the market's 1.0. Meaning it swings 3 times harder. But Saylor counters by pointing to the company's $1.44 billion reserve established on December 1, 2025, to cover interest and dividends, ensuring operational stability even if Bitcoin dips to $50,000. As modeled in their FI 2025 guidance update projecting BTC gains of $8.40 to $12.80 billion. We can see this as a battle of visions. Traditional finance viewing MicroStrategy as a risky leveraged bet, while Saylor positions it as a pioneer in corporate Bitcoin adoption, with recent news like Norway's sovereign fund allocating 1% to crypto in November 2025 validating his thesis. Yet, as we navigate this, the bigger threat looming isn't Nasdaq. It's MSCI, the index giant managing $15 trillion in benchmarks, which on October 10, 2025, proposed excluding companies where digital assets comprise 50% or more of total assets, directly targeting Bitcoin treasury firms like MicroStrategy, with a final decision slated for January 15, 2026, after consultations ending December 15, 2025. This could trigger far larger outflows. TD Cowen estimates $2.5 billion from MSCI-linked funds alone, while JP Morgan's broader tally hits $8.8 billion across global indices, dwarfing the Nasdaq risk and potentially forcing sales in vehicles like the MSCI World Index, where MicroStrategy entered in May 2024. The proposal stems from MSCI's view that such companies behave more like commodities than equities, with volatility akin to Bitcoin's 50% annualized standard deviation versus the S&P 500's 15%, as detailed in their October 29, 2025, update listing preliminary exclusions, including MicroStrategy and smaller players like Marathon Digital. MicroStrategy fired back with a formal letter on December 10, 2025, arguing it's an operating business using Bitcoin as productive capital, supported by figures like Vivek Ramaswamy's Strive Asset Management. which warned on December 4th that the rule undermines index neutrality. And here's a curiosity spark. If MSCI proceeds, could this quarantine Bitcoin companies from mainstream finance, or ironically accelerate adoption by creating dedicated crypto indices? Early signs point to the latter, with BlackRock's Larry Fink revealing on December 4th, 2025, that sovereign wealth funds like those from the Middle East and Asia are buying Bitcoin dips around $80,000, amassing positions worth billions as a hedge against inflation, per reports from CoinDesk. If you're seeing how these index battles could shake out weak holders and pave the way for stronger institutional hands, hit that like button and subscribe so we can keep decoding these market shifts together. Your support helps us deliver the insights that turn noise into opportunity. Continuing on, sovereign wealth funds aren't just watching, they're acting, with Qatar's investment authority reportedly allocating $500 million to Bitcoin in Q4 2025, and Norway's $1.7 trillion fund dipping toes via futures. As Fink noted, these entities view dips as entry points, especially with Bitcoin's 2025 performance up 120% year-to-date despite a November pullback from $108,000 highs. This ties into the ultimate transfer of ownership. Passive selling from index exclusions often hits retail-heavy funds first, allowing deep-pocketed players like BlackRock's iShares Bitcoin Trust, which crossed $50 billion AUM in October 2025, to absorb shares at discounts, strengthening the ecosystem as seen in the 2021 China mining ban that redistributed hash power globally. Looking ahead to what happens next if Wall Street pushes harder on quarantining Bitcoin companies, scenarios range from short-term pain to long-term gain. If MSCI excludes on January 15, 2026, MicroStrategy could face a 20 to 30% stock drop in the ensuing week, based on simulations from Bloomberg's December 1, 2025 analysis, triggering convertible note conversions and potential dilution of up to 10% of shares. But this might also catalyze a rebound as Saylor ramps buys, similar to how the stock surged 50% post-2022 lows. On the flip side, if consultations sway MSCI, with pushback from firms like Strive and even crypto pros like Marco Santori of Kraken arguing the rule stifles innovation, Bitcoin equities could see inflows, with projections from Bernstein on December 3rd estimating $200 billion in institutional capital entering crypto by end 2026, fueled by events like the SEC's approval of spot Ethereum ETFs in July 2025. Volatility forecasts point to Bitcoin testing $70,000 support in Q1 2026 if exclusions hit. But adoption signals shine brighter. MicroStrategy's BTC yield target of 22 to 26% for FI 2025, sovereign funds dip buying, and recent news like Microsoft's December 2025 vote on Bitcoin treasury allocation. Though rejected, it sparked debate. We should watch the MSCI timeline closely. Feedback due December 15th. Decision January 15th. Implementation May 2026, as this could redefine how corporates integrate digital assets, turning index drama into a mere footnote in Bitcoin's march toward mainstream. In wrapping this up, we've seen how Nasdaq's December 12, 2025 reshuffle debate underscored the $1.6 billion forced selling risk. MicroStrategy's 660,624 BTC fortress built on a flywheel of debt-fueled buys, Saylor's unyielding accumulation amid Wall Street skepticism, and the looming MSCI threat that might force $8.8 billion in outflows, but ultimately transfer shares to strong hands like sovereign funds eyeing dips. This isn't just noise. It's a signal of accelerating adoption, with Bitcoin equities poised for the next leg up as institutions wait in the wings, reminding us that in finance, challenges often precede breakthroughs.